Hi everybody, my name is Miro Svoboda. Welcome to the channel. In today's episode, you will learn how to protect your portfolio and how to position your portfolio for more predictable returns using private securities. I will discuss also how major Canadian institutions, including the CPP, Canada Pension Plan, have been positioning their portfolios over the last several years to reduce risk and to ultimately increase long-term returns. Most Canadians are moderate, and most Canadians are moderate investors. And a moderate portfolio is the 60-40 portfolio. And when we say 60-40, it means that 60% of the portfolio is invested in stocks or equities, and 40% of the portfolio is invested in safety, in fixed income. 60-40 portfolio has worked very well over the last several decades and has produced a decent return with fairly low risk. Now we are in a very different market environment. Interest rates are much more volatile, interest rates are increasing, so the 60-40 essentially does not work anymore. The reason for that is the 40% of the portfolio that is invested in fixed income is most likely going to lose money on an inflation-adjusted basis. Who understands this already? Major Canadian pension funds, including the CPP, Canada Pension Plan, which manages one of the biggest portfolios in Canada, has already been shifting. And more than 50% of CPP portfolio is actually invested outside of the public markets. It is invested in alternative investments and private securities. We also understand this is a problem, and that's why we're saying goodbye 60-40 and hello 40-40-20. And what do we mean by 40-40-20 is 40% equities. We still like stock, we still like equities, but the other 40% should be, you should consider private securities, private real estate, private equity, and private fixed income for the last 20%. When you add private securities to a portfolio, you are potentially reducing risk, you are producing more predictable returns, and you adding stability. So overall, 40-40-20 portfolio potentially should increase your returns significantly. Let's discuss private securities in more detail. There are several categories a retail investor could invest in the private space, but the three main categories are private equity, private real estate, and private fixed income or private debt. Private equity invests in private companies. There are about 10,000 public companies that retail investors invest on major stock exchanges in North America, those being NASDAQ, New York, and TSX. Yet there are hundreds of thousands of private companies. And very often in the private space, you will find better valuations, you will find more attractive returns, and very often the correlation with public security is very, very low. So this is very, very attractive for retail portfolios. The second category is private real estate. And just like owning your own home, you're investing, obviously, in real estate. One space that we are fairly excited about is private multifamily housing. So essentially apartment towers, Canadian. And this particular sector has not returned a negative return in the last 30 years. And even during times of crises, 08-09, during COVID, this space actually delivered a positive return. So this is something I like, obviously, and this is something I would want to have exposure in my clients' portfolios. If the public markets are down 40%, and we have an asset class that is actually positive during the same time period, this is something I want. This is something I want my clients to have exposure to. The last category is private debt or private fixed income, and these are privately negotiated loans outside of the public sphere. The other problem with the 60-40 portfolio is that if 100% of your portfolio is invested in public securities, when we're going through a market pullback or market volatility, when markets are selling off, 100% of your portfolio is essentially going down in value. Because people are selling mutual funds, people are selling ETFs, and they're selling everything. They're selling the good, the bad, and the ugly. when you add private securities to a portfolio which have very, very low correlation with the public market, you're actually adding stability. You may be adding stability to your portfolio, but also when markets are selling off, when markets are down, you have a good part of your portfolio that you could be potentially reducing or selling to participate in this market sell-off or in this opportunity. And then when markets do recover, your overall portfolio return may be so much more enhanced. So don't be like this guy. 60-40 is the past. The future, as CPP, Canada Pension Plan, and many other major institutions see it, is 40-40-20, is having your portfolio exposed to private securities as well. Not just public securities, but also private equity, private real estate, and private debt. Doing so may reduce overall volatility and enhance your long-term returns significantly. Thanks for watching, everybody. My name is Miro Svoboda with Easy Retirement with Miro. Please like the channel, please subscribe to the channel. We'll be releasing videos on a weekly basis on tax planning, retirement planning, and overall wealth management. Thanks again, have a great day.